Why do so many funds underperform the market? That's the question. I'm going to show you 10 slides which will explain absolutely everything to you, particularly if you're in Fundsmith or Vanguard Life Strategy funds. Let's look at the data, okay, and put all the biases to one side. So what are the major problems? Well, Fundsmith over the last 5 years has generated 5.8% per annum annualized. Vanguard, 8.7%. Fundsmith's results are not much better than my bank account. Okay, let's look at why they both underperform so poorly against, say, a broader benchmark, a really broad-based one. So we're not going for high-risk benchmarks. We're going for broad-based, the MSCI World Index, or even the S&P 500. Now, some of you will say, well, they're not geared towards competing with those. I'm not talking about competition. I just gave a benchmark. If you don't want a benchmark, look at the absolute numbers. 5.8% from an expert in absolute terms has to be really poor, let alone 8.7%. Both are under 10%. Both are under what simple exchange-traded funds, exchange trackers could achieve. And one of the reasons is their inability to hold cash, for instance. That has two problems. First of all, their mandate restricts their ability to hold cash. So when the markets are falling, they're taking you down with the ride. And it means when the markets recover, they don't have the cash with which to participate on the upside in any event. They also over-diversify, spray and pray, put a little bit in absolutely everything to try and reduce volatility, but that, of course, reduces returns as well. What are the other major problems? Large funds cannot hold, as I said, significant amounts of cash. When they are forced to sell because of redemptions and so forth, it can often be at depressed prices, or just simply because they're selling because, not just these funds, but funds generally, they're selling because the markets are down and eventually the pressure builds up and they're forced into it. They end up getting out, and what they do near the bottom in any event, which is why the recoveries for them take so much longer as well. Inflexibility, that's the problem. They're not nimble like a private investor can be with their cash. That's a major fault. It's not necessarily just the fees. Of course, fees reduce that problem, but that spray and pray and putting small amounts into good companies is one key problem, but putting small amounts into absolutely everything is another problem. One of the reasons they spread themselves thin is because they will have a benchmark against which they measure themselves, and they'll look at that benchmark and what its characteristics are. They'll say, we'll increase a little bit here and reduce a bit there. Easy money if you can get it. Sadly for them, it leads to gambling, because what they're saying is, if things got out of the benchmark, these couple of stocks will do better and these few will do worse. It never works out that way, as Eugene Fama, the Nobel Prize winner, discovered. So muted returns, low volatility, I grant you sometimes, but then again, if that volatility is low because it's bleeding slowly like in 2022, what benefit is it? So look at the work of Nobel Prize winners such as Eugene Fama on this, and you will soon discover that these funds are painful to hold on to over a long period of time. What happens after 5 years? Well, they've taken a large chunk of your money in fees, left you with a low return, by which time you've got so much sunk cost and inertia, which is what they rely on, that you don't leave in any event, not least because you don't know anything better. What are you going to do anyway? Surely this is the way it is. Okay, and you end up with them. I've chosen these two in particular because they're two of the most popular. Were I to summarize those problems before I tell you the next steps of what I think you ought to do, is I think you need to expand your knowledge on investing so you can ask the right questions. Have a look at my free resources at campaignforamillion.com. If you want the hedge fund manager's insider knowledge, I've written 200 columns in the Financial Times, often covering issues like this, 300 shows on Bloomberg TV, 18 books, some of which are published by the Financial Times, by Macmillan, by Wiley. And it's part of that campaign to get this knowledge out there. We're up against multi-trillion-dollar funds, okay, to get this message out. Going to keep plugging it. Do like and follow for more such content. Thank you.